This is our Forex blog for September 3rd, 2013, and in my opinion, the easiest way to trade is using our currency indexes. It lets you see at a glance in chart format what each individual currency is doing. Is it chopping around like the dollar, or like the euro, is it clearly breaking down underneath lows? Which basically means that that's a very strong downtrend. It's underneath the previous day's low. It does bounce off our lower containment bands. Basically, you can look to sell weak currencies like the euro on pullbacks. You wait for a pullback, you look to sell here and here, and basically you can sell it against any currency that happens to be strong at that time. It's that simple. So let's scroll forward and look. Let me link all these together. You easily do that by making the chart colors the same on the top, and click this demo trading button right here on our toolbar, and that way when you scroll back in one chart they'll all line up nicely. Now at this particular time the dollar broke out from below to above its hourly moving average. It didn't break that previous swing high, so it's kind of a bummer. And the pound is super strong, but it's also at our upper containment band, so it could very easily pull back because it's up statistically too much. So the perfect trade would be the pound breaking out, pulling back, being right at a support area. The dollar set up, the euro set up. The dollar, although not as strong as the pound, still has a long potential way to go. So I try to reduce my risk in trading personally. So at 4:30 I would be looking for a euro dollar sell. It's not always going to lead to the biggest profits. As you can see at this time right here, 4:30, it pulled back, not even 10 pips. And I usually use range charts. I show 5-minute charts in our videos. I typically will use range charts just because they're faster and you can see a slew of patterns on them. So if you had taken that 4:30 trade on a range chart, you can see you'd be short your stop above here, and the market's just kind of going up and down, and more than likely I'd be lowering my stop and would have got out of that trade at a near break-even trade. Then you can look for the next pullback trade, get short, and that one is, work nicely, make 15 pips or so. This is why I tend to avoid risky trades, like selling below the lower band or buying above the upper band. Because if you did look for a euro pound sell, euro strong weak, or pound strong, euros weak, if you sold this here, you can see what happened. It went down for about 5 minutes, came right back up, and it's going sideways. Now, you clearly could have got out of this trade at break even. You had 20-30 minutes to get out of this almost near break even, but there wasn't much upside to it. Why take a risk if there's not much potential upside? I want trades that work to give me 2 to 5 times more profit than what my risk is. My risk usually is 5 to 8 pips, so I want minimum 10 to 20 pip profit or more. Hopefully not all trades are going to do that, but that's the whole purpose of trading. Have small losses, big wins. So let's take a look at some other currencies to trade the euro against. The pound was up too much. Let's take a look at the Swiss. And our new currency index allows you to just type in the symbol, and it's going to load the currency index. And this works on all time frames. So you can clearly see the Swiss is weak. And by the way, this is a 5-minute currency index. You could see what the Swiss looked like on a 30-minute chart if you wanted to, if you want to get a longer term perspective, or daily, or weekly. So you can see clearly on the 30-minute Swiss index that has been going down, had one day of a pullback, gap down on Sunday, drifted down yesterday with low volatility due to the US holiday probably, and then it's continuing its trend down. So this is a very weak one. Now let's try the Australian. Put in asterisk and then AUD. Same thing for New Zealand, Swiss, dollar, if you want to take a look at them. So this one, very strong today. And again, like the pound, it was above the upper band. And guess what happened? If you had tried to buy the Australian against maybe a weaker currency earlier, it didn't continue up past our bands. And it typically never does. One day out of 15 maybe, one day out of 10, you'll get price go above these bands and keep going. So this is basically when you want to put on the halt with trading trend and do counter trend. And some counter trend moves, like you see the other day and even today, is a wonderful type of way of catching big profits in the opposite direction. So let's scroll these back, and remember this one's set up. The Australian exploded up earlier, and then it double topped right here and it pulled back. You can see it's statistically very strong. The daily, weekly, monthly trends up. The Euro's weak. This is a very high probability trade. In fact, it's the kind of stuff that I personally love to trade. 430, we're looking for sells in the Euro Australian. You can see that 430 pulled back. Your stop's right above here, and for about 15 minutes it went down, and it fell about maybe 15-20 pips, and then the trend reversed. However, you know, later on in the day, the euro got weak again. You have another trade right here. You have another trade right here, which was a nice one. Another trade right here. Most of these trades are all winners. And if you scroll forward and you look at the euro and the Australian, you'll see that most of the time, you know, on this pullback right here at 6, you know, unfortunately this one had already gone up for about an hour here, but it's going sideways. Sideways patterns are okay. If you look at that chart here at 6, you're looking to sell it, and it goes down about 20 pips. Pretty easy to trade. Now let's look at the Australian versus another one that was weak earlier in the day, the yen. The yen's weak, the Australian is strong, so we're basically looking for Australian yen buys. Strong Australian, weak yen. It's that simple. And this is a good example of why I like to use range charts, because on a 5-minute chart, a lot of times you don't see any entries. And if you use the previous swing highs and lows as stops, you're going to have much wider stops and you're going to risk more. When you see a strong trend like this on a range chart, you can just simply buy a 2, I prefer 3 to 5 bar pullbacks. This is all you're going to get because this is one of the weaker currencies. Put your stop right underneath the low here, and you can see it went up 15, 18 pips very easily. Now again, I bet you if I added my containment bands, the price would be at the upper band here. Containment bands are a wonderful tool. It gives you a wealth of information. I usually add one set of containment bands without any of the exponential or DSP center line to see what the hourly moving average is. And then I will add another one with the DSP option, 1.5 band and 2.0. And typically, in my experience, 75 to 90% of the time, price will reverse at the first or second band. The reason we use DSP-based bands is that they're much faster. Digital signal processing based bands are much faster. If I remove this, you will probably see the band being lower, and so it kind of puts bands farther away from price, and it's more accurate most of the time. See how much lower the band is? You don't want to look for counter trend trades here, and then price continued up, and so forth. DSP bands, because of their very nature, keep you out of counter trend trades until it's very, very likely to reverse. So it's up to you whether you like to buy you know, pullbacks right here. This trade right here, you can see that you have a good potential of it getting to this band here, and it's 15 pips away. It's worth risking 5 pips to make 15 pips. And you could have used these bands to maximize your profit. Another tool that I absolutely love, it's one of the top 5 in our software, is the Perfect Oscillator. This uses statistics. There's no, and it uses statistics on any time frame you want. I typically use the 5-minute data. And what we're doing is we're comparing how far the markets move today to what an extreme distance is at that time. Most of the time, in most currencies, the plus 80 level price is going to reverse. You know, there is exceptions. You know, here price continued down and then it reversed. And when it hit the plus 80 level here, it continued up for a little bit. But this is a wonderful tool, and it can be used in a lot of different ways. Most of the time, when you're not looking at the strongest versus the weakest currency, these bands are going to, you know, tear the market up. And basically how I use it is, if I get a strong move up and I get a pullback and it goes underneath the lower Bollinger Bands around the Perfect Oscillator, this is a pretty decent place to be looking for buys. because typically it's going to reverse. Notice this place right here went up. And once the market's kind of gone up and it's showing you double tops, triple tops, signs of reversals, you can look for counter trend trades when it either hits the upper Bollinger Band or preferably the plus 80 level. So when you saw it hit this level right here, draw your trend line underneath the lows. When it breaks, you go short. Your stop's right above the high. You're risking 5 pips, and if this is a true reversal, most of the time it's going to work its way back to the hourly. So you have absolutely huge 10, 20, 30, 40, 45, 50 pips potential profit while risking this much. Now, who in their right mind wouldn't risk such a tiny amount with the potential of making 5 to 6 times more? That's the only key to trading. If the trade doesn't work, you take another trade, and look what happened. It went to the hourly moving average. And this is also a great place to get back into the trend. Everybody who had bought, typically you can see it wasn't able to go higher for many, many hours. It pulled back, and then traders want to buy the pullback. The hourly moving average is a very high probability place to get in. And also, once it does find support here and goes up, notice swing levels, higher swing high. By the pullback right here, your stop's underneath here, and again, you're just trailing your stop underneath here. You can use chandelier stops. You can also just simply watch our perfect oscillator, and when it kind of starts going sideways or is near an extreme here, this plus 80 level typically is where market's going to reverse, and you can see it did pull back about 15 pips. And again, like I said, when you have a strong trend and you get a move to the lower Bollinger Band, when it goes below the Bollinger Band, especially at the minus 80 level, what a great place to get into these trades. Usually once I see this, I'll kind of wait for a bar to close up, and I'll get in right at the close of the bar with a stop right underneath here. So that's the risk. Even on this trade here that didn't really pan out, your stop's here. It goes up a little bit. You move your stop to break even. It's going up a little bit. It made a higher high here. This was the previous high. It failed to go over that high, so I would have probably exited half the trade there and maybe the other half here. But it's a small profit. You get back in here. It's kind of going back up. Your stop, once it starts going your way, you move your stop underneath these bars. It's just kind of going sideways. You're waiting to see what happens. Pretty much at break even. And then it pops. And of course, you always want to use your Fibonacci profit targets too. Probably 75–80% of the time, that's going to be your maximum profit. And you can draw these on multiple swings to get an even better, higher probability. I don't remember the exact fib level here, but it's the one that's right below the 1.382. It's not used by many traders, but you can use those on longer term swings. This was a 48 pip move, and then when it lines up with a Fibonacci on a shorter swing move, it's pretty high probability. So it's a good place to get out of that trade. And if I don't like to buy breakouts, I rarely ever do it, but if you did buy this breakout here, because it had every opportunity to kind of run out of steam at the highs, and it didn't, and you have a nice little trend line underneath here as a wedge pattern. Wedge pattern breakouts are pretty high probability, but if you bought that breakout here, it only went up 10 or 11 pips. Whereas if you bought it right here, you're in around 78 to 80, and you made 20 pips on that trade. So I prefer to use our statistical tools and buy or sell at much more advantageous levels. Now, before I end today's class, let me showcase how you can do counter trend with this. When you have a currency that's up a lot, the Australian, and especially when you draw the fibs on there, at and beyond the 1.382, it's very likely to reverse. Above our upper band, it's very likely to reverse. And of course, you can draw trend lines on these. And around 1120, this is up way too much. It's at a very likely Fibonacci reversal area. You short this at 1120. So which currency at 1120 is likely to go up? Well, the euro was trending down most of the day. It hasn't really, if it broke above the hourly moving average here, that'd be a pretty high probability. The pound is also, or the yen is also weak. You can see it was just mildly weak most of the day. You can look for I mean, basically the dollar is also above its hourly. You could do Australian dollar sell. Let me bring this up here. At 11.20. And you can see it came up, double topped right here. You might, if you're using a 5-minute chart, sell the bars low. Your risk is very, very minimal, less than 10 pips. And you can see this one fell 10, 20, 25 pips. And for taking counter trend trades, typically what you want to do is go back and draw your fibs on the biggest wave you can find, and about a 38% retracement is usually a decent profit. And so that's 90.33 is your profit target. It came, really within 7 pips of there. So a lot of times I'll exit half the trade when it's going sideways here. I'll put my stop over the high. And when it goes down again, I'm really expecting that to get hit, and if it breaks that, it's going to go to the hourly almost always. So it didn't. Came back up a little bit, so you're out of your second half here, pretty much near where the first one is. Counter trend doesn't always give you the kind of profits that you're hoping for and wishing for. So you got to take whatever the market will give you. And also keep in mind that perfect oscillator, when you have a trend that's up like this and it hits the minus 80, that is an excellent place to get out, because most of the time it's going to reverse violently the other way. Notice again here, perfect oscillator, great time to buy the strong uptrend on the pullback. And if you also notice here and here as well, every single time the perfect oscillator got hit, even this one right here went up 10 pips. 1, 2, 3, 4, 5. 5 times, all bounced. And the trend's up. You're using this primarily to trade with the trend.